Hi guys, welcome back to InvestPure channel. Today let's discuss your short-term goal, medium-term goal and long-term goal. Basically it is all about your financial planning. So let's understand short-term goals. So most of the people, they do mistakes like investing in equity or investing in equity mutual funds for their short-term goals, say around 1 year to 3 years. Now if you are investing in equity and that too 1 year or 2 years money, and you need that money for your child education or for any emergency or for any short-term goals like going for a vacation or maybe buying a car kind of. So what happens if you are investing in equity and what happens after 1 year the market is down by 10%? So you will be stuck and you will blame your advisor or you will blame the market. So for that particular reason, what you should do is you should not put your money into equity, you should put into debt funds. Now you have to understand which debt fund is good for you. What kind of returns you are looking for? Are you looking for 12%, 15% kind of returns which is normally generated by equity market with a lot of risk? The answer to this question should be no. The debt fund is going to give you slightly better than your FD, but the main objective is to protect your money, to give you something better than FD. And whenever you need money, you can take out. So short-term goal cannot be invested into any equity mutual funds. Any means any. Let's understand your medium-term goal. Let's say I am at 30s and I want to book a house which is loan-free. So I need a corpus of let's say 2 CR or 1 CR, whatever budget you have. So in our opinion, you should have a time frame of 4 to 5 years to 10, 15 years. So you start accumulating today and start investing in next 5, 10 years, 20 years or whatever period you are planning to accumulate that 1 crore or 2 crore money and then buy your home. Do not get into loans. The second point is, what are the funds you should go for? So the fund will depend like how much time you have. Let's suppose you have time of 5 years or more than 5 years, 5 to 10 years let's say. So you can go for large and mid cap, there is no problem at all. So large cap can deliver 11 to 12% returns. Mid cap can deliver 15 to 18% kind of returns and small cap can deliver 15 to 20% in the range of 15 to 20%. So in short, you can actually invest your money based on your risk appetite for a period of 5 to 10 years. There is no problem at all. And once you get that 1 crore, 2 crore, the accumulated amount is that much, then you can take out and you can buy your home. Let's understand what is your retirement plan, which is really long term. So today, let's suppose I am at 30 and I have another 30 years to accumulate money. So very small amount you can put in an SIP format or daily SIP or weekly SIP or fortnight or maybe monthly SIP and accumulate for a next 30 years period. What is most important here is you should mix the asset class. You can go for small cap and mid cap, and time to time you have to book profit from mid cap to small cap or small cap to mid cap or large cap. Depending upon the market situation, your advisor will definitely advise you based on the market valuations. So you have to take out money from small cap to large cap or large cap to small cap or large cap to mid cap. All this juggling is going to be done by your advisor. So SIP or STP is recommended for small cap and mid cap for a longer period of time, which can give you tremendous value, which may be around 18 to 20% kind of returns, and you will be able to achieve your 10 crore, 20 crore or 50 crore kind of goals which you have for your next 30 years for your retirement. So in step 2, let's understand the risk appetite. So I'll tell you the risk. People used to misunderstand the meaning of risk. Here the risk is your volatility risk. It is not that you will be losing 100% of your money in mutual fund. You cannot, right? That is the best option in India. If you want to get better returns through let's say equity market, you should participate through mutual fund because there are a lot of management. Stages of management. So going wrong or losing your entire money in mutual fund is next to impossible. You may lose some part of it, let's say 5%, 10% loss because the overall market is down, but you will not lose the entire amount. So what is risk? We always say it is volatility risk. Let's say for an example, you have planned for your retirement planning, okay, for your retirement, and you have a time frame of 30 years. Then what happens when market is down? Let's say market is down by 30% because of corona. So your behavior changes. So now because of negative market, negative situation, negative environment, your advisor have to convince you or motivate you to stay invested. In fact, if you have money, you can increase the investments to get better returns. So it's a behavioral difference, behavioral risk. So if you behave negatively, the market is negative, the society is negative, and your advisor is negative, then you'll take out the money and with a loss of 30%. That is called loss. That is called risk. So risk management should be taken care by your immediate advisor or distributor who can convince you not to take out money at a negative time. Second, the volatility risk I'm talking about. Whenever you are starting investments, in first 2-3 years, the market will be keep on, the market volatility will be very, very high. But if you have a plan of 30 years, you should not worry about the short-term volatility, and which is called, risk. So in this way, you can convince yourself not to take money at the bad time. And anyway, you always should remember why you are keeping this money, for what period you have discussed while investing. So you stay calm, stay invested for next 30 years, you will definitely get the money. But I am not saying that your advisor should not work on this. He will definitely work on this, or you can talk to the advisor asking that whether the investment is doing well or not. If investment is not doing well, or you see that potential risk is coming up, then you can switch from one fund to different fund for your safety. But the SIP should continue. You should not be worried about SIP. The most important part you should understand, the expense ratio in your mutual fund. So some are the funds which is very small in nature. The expense ratio must be close to 2.5%, which is the maximum set by SEBI. But more or less, if it is between 2.2 to 2.5, it is high. Now, in the similar category, if you are choosing one fund which is already existing and having good size of money, then you see the expense ratio maybe 1.5, 1.6, 1.7 kind of, so which is cheaper than the 2.5, 2.3, 2.2, right? That is number one. Number two, if your money is big enough, then this expenses matters a lot. Second, you have to check the performance. So expenses versus performance. If you see some value, then there is no harm paying 50 bips extra on the same fund manager or the same fund, because you are getting 5% more returns or 4% more returns. So it is good. If you see the performance is lesser than the average category, then you should think of expense ratio. If it is higher, then you have to switch from that fund to a different less expensive fund. Now let's understand the diversification in the portfolio. So what do you mean by diversification? There are a lot of meaning to diversification, right? So one is asset class. The second is within asset class, segment wise diversification. Third is the fund manager diversifications. Fourth is AMC diversification. There are a lot of diversification meaning, right? So let's understand why diversification is important. Let's say, for an example, for the last 1 year, market is at same level or trading in a range where if somebody invested in only one segment of, let's say, small cap or mid cap or large cap, then probability of earning good amount of money is less. But at the same time, if you talk about an asset class which is gold and silver, probably they have delivered better return than the equity. So if you have some money invested in debt and gold and silver as a commodity investments, it is going to definitely give you money. So now you have two options. One, either you go ahead and buy gold in physical, or you buy a gold ETF, or you buy a gold fund, or you buy a multi-asset allocation fund where 20 to 30% money should be invested into gold or silver. Similarly, in the multi-asset allocation fund, you have asset class called arbitrage. When market is not moving anywhere, for the last 1 year, let's say market is trading in a range and not generating any profit in your portfolio, you should think of arbitrage, which is giving you a fixed return of 8.5%. And then there are another opportunity which is called debt fund, which is government bond, government securities, which is again giving you a returns of, let's say, 8% to 9.5%, 10%. Because today the scenario is the interest rate is going down, hence your yield of different bonds are increasing. So if you talk about any corporate bonds, let's say HDFC corporate bond fund, any bond fund for that matter, you see the net yield today for the last 1 year it is more than 10%. But in equity funds, small cap, mid cap, any other equity fund, the returns are not there, like 10%. So you have to diversify your money into different asset class based on the valuations, again based on your requirements, your thought process. I mean, if it is short term, then debt fund is better, multi-asset allocation is better. So today I have encountered with one client who is a retired client and was asking for 20 lakhs allocation. I said, what is the purpose? I should get something better than FD and some tax benefit. I mean, if I can save some tax. I said, okay. So in FD you are anyway taxable at 30%, right? But in case of if you are going for a debt fund, that is the taxation is the same. So to create more value, you should go for a multi-asset allocation fund, and he agreed that okay, I can have 3% ka fluctuations and then I can target for 10 to 12% returns, and it is definitely going to reduce your tax burden of 30% to 12.5%, because multi-asset allocation fund is actually taxable at a equity taxation kind of treatment. So it is better to understand what exactly you want. Once your need is clarified by your advisor and you, then probability of giving a good advice will be better. Now let's understand what is the mistakes you are doing. So you as an investor, you should have a track. What kind of track? You always ask the advisor or maybe distributor, asking that how often they do advise or how often they do review of your own portfolio. But trust me, it is your money and you should be more concerned than the advisor, than the distributor, right? So I appeal that you should remind if your advisor is not reminding, because it is your money. If the value is not created, then you are the loser who is going to lose. So it is a request again to stay in touch with your distributor or advisor and regularly monitor your investments. So at least 3 months, in a quarter, at least once in a quarter you have to talk to your advisor. If he is not calling, you call. Doesn't matter. Don't get into the ego kind of attitude that my advisor should call, he is getting commission. No. It is your hard-earned money. He is getting commission of 0.5%, but your entire 1 crore, 5 crore is lying with him. So please take it very seriously to review your portfolio regularly.